Okay, let's go ahead and run through the solution to example 4-2. Again, this is a wholly owned subsidiary with a differential. And just to refresh our memories, assume that on January 1st, 2001, Big purchases 100% of Little for $350,000. Little's book value on that date was $300,000, and Little had the following misvalued or unreported assets and liabilities. They had some inventory on a FIFO basis undervalued by $20,000. Property, plant, and equipment with a 10-year life overvalued by $50,000. Bonds payable with a 5-year life undervalued by $10,000. In-process research and development undervalued by $5,000. Customer lists with a 4-year life undervalued by $30,000. And at the end of 2001, Big determines that due to impairment, the correct goodwill balance should be $40,000. And finally, during 2001, Little reports earnings of $40,000 and pays dividends of $30,000. So first thing we have to do is go through our differential analysis. The information regarding the misvalued assets and liabilities is indicated at the top just for easy reference. So for the differential analysis, we start with the fair value of the subsidiary on date of acquisition, subtract out the book value, and that gives us our $50,000 differential. Again, this means that Little is worth $50,000 more than book value, and the question is what explains that $50,000 of additional value? And so we'll just go run through the list. First, our inventory is undervalued. If the inventory is undervalued, that means it's worth more than book value, which means we're willing to pay more than book value. So that explains away part of that $50,000 premium that we paid. That's why we subtract it. Next, the property, plant, and equipment is overvalued. And again, if we subtract an undervalued asset, we add an overvalued asset. Now, as far as the amortization is concerned, the inventory, we assume a FIFO inventory flow, so all of that will be amortized in the first year. The property, plant, equipment has a 10-year remaining life, so it will be amortized at $5,000 per year. We also need to add our undervalued bonds. Again, we subtract an undervalued asset, we add an undervalued liability, so that $10,000 difference amortized over 5 years will be $2,000 per year. And then we have our two unreported or underreported assets. In-process R&D worth $5,000. Undervalued asset, we subtract that. That'll be written off over 2 years. And likewise, our customer list worth $30,000 to be written off over 4 years. Again, the in-process R&D and the customer list probably didn't even exist on Little's balance sheet. They were internally generated or internally created, but they had value at the date of acquisition, so we're going to go ahead and assign them value on the consolidated balance sheet. The remainder, if it's positive, is goodwill. If it's negative, it'll be a bargain purchase. So let's go ahead and run through our equity method entries. And again, it's going to be income, dividends, amortization. Little reported $40,000 in income. Big owns all of Little, so Big owns all of that income. Little also paid $30,000 in dividends. That was all received by Big, and they lower their investment in Little. And now the amortization entries. Again, we've got a bunch of finite-lived differential items, both assets and a liability, and those finite-lived differentials need to be amortized or written off over those finite lives. So first, the inventory differential. Again, amortized all in one fell swoop. Again, what's potentially confusing is when do you debit investment income, when do you credit investment income? This was undervalued inventory, so again, we talk our way through this. We say, okay, Little had undervalued inventory, therefore they understated their cost of goods sold, therefore they overstated their income. We need to lower the income to compensate for that. So we're going to go ahead and debit investment income and credit the investment in Little. Now the property, plant, and equipment was overvalued. So again, you could either talk your way through it and say, okay, their property, plant, and equipment was overvalued, which means they took too much depreciation expense, which means they showed too little income, so I needed to adjust the investment income upwards. Alternatively, you could keep in mind that, again, if an undervalued asset being amortized reduces investment income, then an overvalued asset being amortized increases investment income. Next we have our bond differential. Going to go ahead and amortize 2,000 of that. Amortize our research and development differential, and amortize our customer list differential. Again, the R&D differential and the customer list, those are both assets that are being written off. Writing off those assets reduces our income. Finally, we have our goodwill impairment. Again, just a moment ago we estimated that goodwill was $55,000, but in the problem description it stated that at the end of the year the reported goodwill should only be $40,000. So we have to go ahead and write off $15,000 of that goodwill. And again, under the equity method entries, the process of impairment or amortization involves adjustments to the investment income and the investment in little. Now let's go ahead and go through our elimination entries. And again, as always, we start with the S entry. We eliminate the subsidiaries' beginning of year owner's equity accounts. And now we need to go ahead and create all of those differential asset values. Inventory was undervalued, so we're going to go ahead and write up inventory by $20,000. Property, plant, and equipment was overvalued, so we're going to go ahead and reduce property, plant, and equipment by $50,000. The bonds were undervalued, so we have to add $10,000 to the bonds payable. Now we don't want to directly increase bonds payable because obviously bonds payable are reported at face value. What we need to do is create a premium on bonds payable. We need to go ahead and create that in-process R&D asset, and we create that customer list asset. And finally, we create that $55,000 in goodwill. And again, if you net together all those 7 debits and 2 credits, you end up with a total of $350,000, which is the beginning of year investment in little balance. Now the A for amortization. Again, of those various differential asset and liability values, all of them, except for goodwill, have a finite life. So all of them are going to involve being written off over time. The inventory, again, we assumed a FIFO inventory flow, and as long as little has an inventory turnover of at least 1, all of that inventory has now been sold, and so that $20,000 of additional value needs to be transferred to cost of goods sold. The in-process R&D being written off over 2 years, so we debit R&D expense and credit in-process R&D. The customer list also needs to be written off, in this case over 4 years at $7,500. And now we need to write off that property, plant, and equipment differential. And again, in the S entry we credited property, plant, and equipment net, so in the amortization we're going to be debiting property, plant, and equipment net, and we're going to be decreasing depreciation expense. And then finally, the premium on bonds payable needs to be amortized as well. And as you know from your earlier financial accounting classes, amortizing a premium or discount on bonds involves an adjustment to interest expense. Then lastly, we have the impairment loss. Again, in the S entry, we created $55,000 in goodwill. That was the beginning of year value. By the end of the year, that's been impaired. We have to reduce it down to $40,000, recording a $15,000 impairment loss. I for investment income. If you look at those equity method entries we went through just a few minutes ago and added them all up, you'd find that net investment income was $2,000. That has to be eliminated. And then lastly, D for dividends, we eliminate the subsidiaries' dividends declared with a credit, debiting the investment in little. Okay, so now let's go ahead and run through our worksheet. So there's our worksheet with the elimination entries indicated on the left-hand side just for reference. I apologize for the small font on the account titles and the amounts. There's simply no way around it for some of these exercises. Clearly, it would have been helpful if I could have netted together all of the assets and netted together all the liabilities and netted together all the expenses, but for this example we want to have the individual assets, liabilities, and expenses listed so we can show how the posting of these elimination entries affects those various accounts. So first let's go ahead and post our S entry. So first we post our S entry, debits to the debit column, credits to the credit column. Now the hard part of this whole process is creating these elimination entries. That's where you have to stop and think about things and do the entries properly. Once you have the elimination entries, the balance of this is simply a mechanical process, posting the debits to the debit column and the credits to the credit column. It's simply a mechanical process. There are a few areas where it's possible to get confused. We have to remember that when we adjust retained earnings, we always adjust beginning retained earnings and let that flow through to ending retained earnings through the worksheet process. And we have to keep in mind the distinction between investment income and investment in little. But aside from that, this is a very straightforward mechanical process, posting debits and credits to the appropriate debit and credit cell in the worksheet. Next, we need to post our A for amortization entries, and again, debits to the debit column, credits to the credit column. So for the first one, we're going to go ahead and adjust a debit to the cost of goods sold up in the income statement and a credit to inventory down to the balance sheet. We record $2,500 of R&D expense, and we credit in-process R&D down in the balance sheet. And just for the sake of saving a little bit of space, I'm going to go ahead and put the R&D expense simply under operating expenses. Likewise with the amortization of the customer list, $7,500 to operating expenses, a $7,500 credit to customer lists. The property, plant, and equipment differential, in this case, we're debiting, in the S entry, we credited property, plant, and equipment net. Now we're debiting it to amortize it. So a debit to property, plant, and equipment net, a credit to depreciation expense. Likewise with the amortization of the premium, again, amortizing a premium is an adjustment to interest expense. And then we have that impairment loss, a $15,000 impairment loss up in the income statement, and a $15,000 credit to goodwill. The I for investment income entry. This should be the easiest entry of all. Basically, we see that there's a $2,000 balance in the investment income. If you look at Big's column, the 6th or 7th cell down under the big column, investment income is $2,000. That's positive income, so it would be a credit. To eliminate that, we have to debit investment income for $2,000. No thought involved, no addition, no subtraction. Basically, whatever the investment income is, it has to be eliminated. And then finally, the D for dividends entry, we credit dividends declared and debit the investment in little account. Before going any further, I can't stress enough the value of footing these two columns to make sure that debits equal credits. Now, when you're creating those elimination entries, at this point of your career as an accounting student, it should be virtually impossible for you to write a journal entry that doesn't balance. It should just rub you the wrong way in the depths of your soul. So if our journal entries all individually balance, when we post them to the debit and credit columns, they need to still balance. And if you foot those two columns and find that they don't balance, then obviously you made a mistake somewhere in the posting process and you need to go back and find the mistake. I can't tell you how often in reviewing students' work in the past, students get stuck on the worksheet and they just can't get it to work out. Something's wrong and they're not sure what. If they had taken a moment to, foot those debit and credit columns, they would have realized that, hey, they don't balance. I made a mistake somewhere in the posting process, and they can go back and check each entry to make sure it was posted properly to the worksheet. So again, having the debit and credit columns balance isn't a guarantee we did it correctly. We could have omitted an entry entirely. We could have put a debit, instead of putting a debit in cost of goods sold, we could have put a debit in depreciation expense, but at least it makes us a little more certain that we didn't make some gross error of overlooking half of an entry or something of that nature. Now we go through the process of completing our worksheet. And again, for every one of the revenues and expenses in our worksheet, we simply add across, keeping in mind the appropriate debit and credit rules. Sales has no adjustments, so we simply add across. Cost of goods sold, we have a $20,000 debit. That increases cost of goods sold. Depreciation expense, we have a $5,000 credit, so that's going to decrease depreciation expense. And likewise for operating expenses, interest expense, and so on, we're going to adjust those up or down based on the appropriate debit and credit rules. Once we get to the bottom of the income statement, when we get to consolidated income, we want to be sure we work down the income statement. Consolidated sales minus consolidated cost of goods sold minus consolidated depreciation expense, and so on. We do not simply add across the consolidated income row, because then obviously we would not get the desired $27,000. We immediately post that to our statement of retained earnings. And now we can complete our statement of retained earnings. Again, adding across beginning retained earnings, adding across the dividends row, and then again, to get the ending balance, we have to work our way down the statement again. So beginning consolidated retained earnings plus consolidated income minus consolidated dividends equals ending consolidated retained earnings, which we then transfer down to our balance sheet as ending retained earnings. And now again, we simply add across all of the rows of our income statement, keeping in mind the appropriate debit and credit rules. It's not, I don't think it's worth our time adding through each one individually through the narration. I just want to point out that, again, the investment in little account is a nice little check figure for us. That account has to net out to zero. If that account doesn't net out to zero, then something is wrong. As a final check, it'd be nice to confirm that our balance sheet does in fact balance, that assets equal liabilities plus equity. Finally, let's go ahead and look at the initial elimination entry for the following year, the S entry for the following year. And it might be handy at this point if you could print out or refer back to the elimination entries and see how they carry forward to the following year. Again, we're going to eliminate Little's beginning of year equity accounts. Common stock and additional paid-in capital are still $50,000 and $100,000 respectively. Little's retained earnings at the end of the first year was up to $160,000. Their beginning retained earnings was $150,000 plus $40,000 of income minus $30,000 of dividends. So their end of year one, beginning of year two retained earnings is $160,000. And now we think of how those various differential assets are being carried forward. The in-process R&D. Last year we created a $5,000 in-process R&D asset. We amortized half of it, so we're carrying forward $2,500. Note that the inventory differential is gone. Last year we created a $20,000 inventory differential and then amortized the whole of it, so there's no inventory differential being carried forward. Next are customer lists. Last year we created a $30,000 customer list asset and then amortized $7,500 of it, leaving us with $22,500 being carried forward. Goodwill, in the S entry last year we created $55,000 and then we took away $15,000 in the impairment, so we're carrying forward $40,000. Property, plant, and equipment net, in the S entry we created a $50,000 differential and then we took away $5,000 of that through amortization, so we're carrying forward $45,000. And then lastly, the premium on bonds payable. Last year in the S entry, we created a $10,000 premium and then amortized $2,000 of that. So if you net together all 8 of those accounts, they add up to $322,000, which was in fact Big's end-of-year balance last year in the investment in Little. Now, that $322,000, it would be nice if there was a simple thing we could call that. It's not the book value of Little, and it's not Little's fair value either. Basically, it's Little's beginning of year book value plus the remaining unamortized differential assets and liabilities. But in any event, this is now year 2, we're carrying forward all of these differential assets, and now again we will subject them to appropriate amortization. In-process R&D will be written off entirely this year. We'll take another $7,500 of amortization of the customer list. We'll take another $5,000 of amortization of that property, plant, and equipment differential, and we'll take another $2,000 of amortization of that premium on bonds payable.